Caleb Silver, the editor-in-chief of Investopedia, is joining me now to break down some of the mechanics behind the company's major move. Good morning.
Good to be with you as always.
It's great to have you back on the show. You know, this announcement was made roughly 10 months ago. Talk to me about, well, actually take our viewers through exactly what typically happens between the time that it was announced and getting here today.
Yeah, this is kind of cool. This is what we call a reverse takeover, or in Ireland they call it a scheme arrangement. Not your typical merger, because Smurfit Kappa did form a limited liability company to buy WestRock, which is based in Atlanta. Smurfit Kappa, of course, an Ireland-based company, and then moved the listing here to the New York Stock Exchange. Broader exposure to shareholders, right? So you're right, 10 months in the making. They proposed this in September of 2023. Shareholders voted on June 13th to approve this unanimously, 99%, and then July 5th it closes, begins trading here today, also started trading ordinary shares in London.
Talk to me about the benefits of moving their listing from Europe to the NYSE. What advantages does the company have now?
Yeah, well, you got a broader investor base. This is the New York Stock Exchange. This is prime time right here. So you want to be where the big investors are, also where the big market makers are. You want to be able to have market makers here making market for your shares to get investors more interested in it. It widens the exposure, and the company's been very candid about this. They'd like to be listed in some of the big indexes, and when you get listed in the big indexes here in the United States, a lot of investors have to own your share. So this is a big deal for both companies.
And you know, I want to look at something right here. So WestRock shares ceased trading on the NYSE last Friday ahead of the Smurfit WestRock beginning to trade as a combined company. So talk to me about what determines where shares of the company stop trading and what are the effects of that?
Yeah, because this is what we call a reverse takeover or a scheme arrangement according to the 2014 Ireland laws. They actually set the price when they agree on the merger. When the shareholders agree on that merger, and this is 50.4% go to the Smurfit shareholders here, 49% to the WestRock shareholders. They agree on the price exchange. Then there is no reason to IPO here. The exchanges already know the set price based on the last trades of these companies and where they agreed to merge. So there's no big IPO, there's no new listing of shares here. This is a new combined entity starting to trade today here on the NYSE.
And you know, I just want to point out right now to our audience, we're getting images of John Tuttle right there with the executive team of Smurfit WestRock making their way down to the trading floor before they get ready to sign the Distinguished Guest Book. But you know, let's talk about this merger, how it really consists of two rivals essentially, right? We have a paper and packaging industry, Smurfit Kappa and WestRock. They're coming together. Talk to me about what are some of the advantages actually of this happening, and then when it comes to two players in the same space though, there's some risks that go along with it. So walk me through this.
Totally, and it's about global reach, right?
Yeah.
If you think about Smurfit Kappa, huge in Europe, right? They have a very established market there. This company's been around since 1934, didn't just get here. So a pretty big market. They've gone through a bunch of acquisitions. They were private at one point in their lives, and now they're a pretty big company in Europe. But when you look at WestRock, you're talking about a company that has exposure in South America, exposure in Mexico. So this is about widening the control over the market internationally. That's a pretty big deal for both companies because packaging is only going to keep growing. Think about the things that these companies make. Corrugated packaging, packaging for wine bottles or soda bottles. We use them all the time. We might not know the product, but we're using them all the time, and this is only going to expand. They want to move into more sustainable packaging. Pretty big market there too.
So Smurfit WestRock, you know, it's an international company. It's an international listing, right? But it's not undergoing a price discovery process. However, some other companies do. In fact, you know, we have Australian-based Tamboran did earlier this month. They went through a price discovery process. So what's the differentiator here?
Yeah, price discovery is when you're actually listing here for the first time on the New York Stock Exchange, or you go through an IPO. There are market makers down there that are setting the price based on the bids coming in before your shares open for trading. So in this case, the deal was pretty well known. The terms of the deal were well established. So there's a exchange of shares here, and there's also an exchange of cash. No price discovery needed because we know where shares are going to open versus them saying, hey, we're going to IPO here at the New York Stock Exchange for the first time. We're going to get the bids and asks in before the opening bell to see where we should set the price, and then the opening bell rings, and that's where the price starts. Here, the discovery is already known. We know what the price is going to be as soon as the stock opens.